to discuss organized money market. Since the government started developing the organized, since the government has started developing the organized money market in India in mid 1980s, we have seen the arrival of a total of 8 instruments designed to be used by different categories of business and industrial firms. A brief description of these instruments follows: treasury bills. These instruments of the money market, though present since independence, got organized only in 1986. They are used by the central government to fulfill its short-term liquidity requirements up to the period of 364 days. They developed 5 types of TV in the course of time: 14 days, 14-day intermediate TV, 14-day actionable TV, 91-day TV, 182-day TV, and 364-day TV. Out of the above 5 variants of the TV, at present only the 91-day TV, 182-day TV, and 364-day TV are issued by the government. The other 2 variants were discontinued in 2001. The TV, other than providing short-term cushion to the government, also functions as short-term investment avenues for the banks and financial institutions, besides functioning as requirements of the CRR and SLR of the banking institution. Certificate of deposits organized in 1989. CD is used by banks and issued to the depositors for a specified period ranging less than 1 year. They are negotiable and tradable in the money market. Since 1993, the RBI allowed the financial institution to operate it in IFCI, FCI, IDBI, IRBI, IIBI since 1997, and the Exim Bank. They can issue CDs for the maturity periods above 1 year and up to 3 years. Commercial paper. So organized in 1990, it is used by the corporate houses in India, which should be a listed company with a working capital not less than 5 crore. The CP issuing companies need to obtain a specified credit ratings from the agency approved by the RBI, such as KSL, ICRA, etc. So commercial bill, CB. So organized in 1990, CB issued by all Indian financial institutions and non-bank finance companies, NBFC and scheduled commercial banks, merchant banks, cooperative banks, and the private mutual funds. It replaced the old bill market available since 1952 in the country. Called money market. This is basically an interbank money market where funds are borrowed and lent generally for 1 day. That is why this is also known as overnight borrowings market, also called money at call. Funds can be borrowed, raised for a maximum period up to 14 days, called short notice borrowing. In this market may take place against securities or without securities. The rate of interest in this market glides with the repo rate. At the time, the principal remains very simple. Longer the period, high the interest rate depending upon the availability and demand of funds. In this market, the real call rate revolves nearby the current repo rate. The scheduled commercial banks, cooperative banks operate in this market as both the borrowers and lenders, while LIC, GIC, mutual fund, IDBI, and NABARD are allowed to operate as only lenders in this market. Money market mutual fund, popular as mutual funds. This money market instrument was organized in 1992 to provide short-term investment opportunity to individuals. The initial guidelines of the mutual fund have been liberalized many times since March 2000, MAF have been brought under the purview of SEBI. Besides the RBI at present, a whole lot of financial institutions and firms are allowed to set a set of MJMFs, that is commercial banks, public and private financial institutions and private sector companies. At present, 45 MFs are operating in the country, managing a corpus of over which is 4 lakh crore. Repos and reverse repo in the area of economic reforms, they developed two new instruments in money market, repo and reverse repo. Considered the most dynamic instruments of the Indian money market, that they have emerged as most favored route to raise the short-term funds. Or in India, repo is basically an acronym of the rate of repurchase. The RBI is in a span of 4 years introduced these instruments, repo in December 1992 and reverse repo in November 1996. Repo allows the banks and other financial institutions to borrow money from the RBI for short term by selling government securities to the RBI. In reverse repo, in the banks and financial institutions purchase government securities from the RBI. Basically, here the RBI is borrowing from the banks and the financial institutions. All government securities are dated, and the interest for the repo and reverse repo transactions are announced by the RBI from time to time. The functions of repo and the reverse repo have been able to serve the liquidity evenness in the economy, as the banks are able to get the required amount of funds out of it, and they can park surplus idle funds through it. These instruments have emerged as important tools in the management of the monetary and the credit policy in recent years. Accepting the recommendations of the Urjit Patel Committee, the RBI in April 2014, while announcing the first monthly credit and monetary policy 2014-15, announced to introduce the term repo and term reverse repo. This is believed to bring the higher stability embedded signaling of interest rates across different loan markets in the economy. Case management bill. The government of India, in consultation with the RBI, and they decided to issue a new short-term instrument known as cash management bill since August 2009 to meet the temporary cash flow mismatch of the government. The cash management bill are non-standard and discontinued instruments issued for maturities less than 91 days. So the CBM have the generic character of treasury bills, issued a document to the face value, are tradable, and quality of ready forward facility investment. It is considered as an eligible investment in the government security. The banks for reseller. It should be noted here that the existing treasury bills have the same purpose, but as they were get put under the WMA, ways and means advances provisions by the government of India in 1997, they did not remain a discretionary route for the government to in meetings in short-term requirements for funds at will. Fiscal consultation in India subtopic that is chartered in public finance for details. CBM does not come under the similar WMA provisions. So mutual funds next to discuss. Thank you.